Oh, good afternoon, ladies and gentlemen. Great pleasure to be with you this afternoon for the presentation of our annual report along with our business update. What we do each year is we have our accounts audited. As part of that audit process, we have Darren Tam here today, which will provide you an auditor's brief on what he's done for that audit, but also and what he's looked at the financials. So I'll just ask Darren to come up and say a few words about that audit process.
Hi, I'm Darren Tam from Jessops. As Jamie pointed out, you might have noticed brief and a few words, so I will keep it to that. Jessops is a local firm based in Townsville and Cairns and Brisbane now, because we followed Jamie down there. We heard that it was a place of growth and development. I've been involved with Investors Central now since 2016, so that's 8 years of doing the audit with Jamie, and I've watched the business grow over that time. It's been an interesting ride. As an auditor, part of why you guys look to me is for comfort. You want assurance over the numbers that Jamie's presenting to you, that they're presenting a true and fair view. So the audit's looking at areas in the financial statements in which we perceive there to be risk. Jamie's business model is actually quite simple. So from an audit perspective, what we're looking for is to make sure that the assets that are shown there are shown at their correct value. The loan book of all of the loans that they've made are collectible over time. That's where we spend our main time. And I must admit, this year was a challenge for me intellectually. I was expecting it to be worse. When you read the financial press or you listen to a politician, life is hard, costs of living, etc., etc., etc. So I was expecting the loan book to have circumstances being reflected in the repayments. As I said to the accounting team, it didn't have that. What was I missing? For the first time in many years of me auditing this organisation, the loan book actually was of a significant better quality than I've seen in previous years, which didn't make sense to me intellectually until I started to look into what was going on and looking at the cohort of the loans that are there. There seems to have been a different impact after COVID on the loan book in Investors Central and Finance One than what the big banks have experienced. There seems to be a better quality of loan that Finance One is advancing to the people out there, the 4,000, 5,000, 6,000 people that are borrowing money off of Finance One, and they're all repaying it. It seems that the car is important and they make those repayments. So you can take my word, I was quite happy that the loan book is what I would consider collectible. I'm here, as Jamie said, a few words, I've gone over that, sorry mate. I'm here for the lunch for the purposes of you guys can come and ask me any questions that you have. So see me around after the lunch if you want to ask me any questions. But I'll hand back to Jamie and the team and you can look at the real numbers and put them up on the screen.
Thank you. What's interesting about that is Darren's also been really good with our new Darren, which is the CEO, and Lachlan, who's come and joined our team too. So our CFO, Jason Griggs, here today, and Ashish is here today. So we've expanded the team. We've got more capability than we've ever had before because we want to have transparency through the numbers to be able to make sure that we can meet our obligations to everybody. Darren touched on something there, that we were very cautious about our growth in regards to the last 18 months, and we've actually changed some of our lending policies, and Darren Cantor will give you an insight into that. If you could picture me 27 years ago going out there and door knocking in 1997 and writing loans. So I was a younger man than I am today, but I was a bit bigger. And I was just chatting to an investor before in regards to, what did you go out door knocking? So it's one thing to lend money, but you've got to go and collect it. So I was out there 3 nights a week and collecting on these loans. It was the forging and the making of our company because you want to understand whom you're lending to and why you're lending to them. but also you want to refine that because you don't want to be out 3 nights a week doing those collections. Simple as that. And one of the investor asked me, well, did you have any problems? I said, no. Always treated people with the respect and the dignity they deserved, but I've jumped a few fences. So I was probably about 10 kilos heavier back then, and if you could see me scaling, being chased by a couple of dogs, it was on. But you know, your heart races and just brilliant. Those were the fun days. My wife and I, we would work in the shop on a Saturday, and my wife Deanne is here today, and then we would pack the kids up on a Saturday afternoon with lunch boxes, and she would sit in the car while I went and did 3 or 4 field calls. So you can imagine Dee sitting in the car going, shit, he's been in there for a long time. I wonder if he's coming out. And her mind would race because your subconscious thought. Deanne's never asked for anything from me other than time. She's the greatest thing that has ever happened to me. I love you to bits. You are the forging of my family, and I'll respect you forever. Our company, Investor Central, it's an unlisted public company and it owns the brands of Finance One, Strategic Collections and Commercial Credit Control. Predominantly, we are focused on lending money. We've been doing it for a long period of time. We established Investor Central so we could raise capital. In those early days when Deanne and I were doing it, we just used our own capital and the business outgrew what we were able to fund, so we raised capital from investors. And over that time, the investors provided us extra funds so we could expand and grow our business. That's continued. And we've even outgrown our investor base for the amount of money that we need to raise to be able to continue to fund that business. So we've got things like a line of credit from a large financier now. And you'll see that that's part of our left-hand side column, which is our asset-backed securitization program. So we've raised over $200 million from those investors that sits outside of the group. So they fund a separate pool of loans. They do not have a lien over Investor Central. You as investors rank first in preference to be paid. That has not changed. We do need that extra funds though to be able to continue our growth into the future. The mainstay of our business has been the credit policies that we've been able to develop to help Australians and give them an opportunity where they are excluded from the larger financiers. It is tough at times for a small business or a business to find capital from the bank or from our larger financiers. The loops and hoops that you have to go through is frightening. And it's the same thing for those consumers. We help so many consumers get financial freedom through an opportunity to own a motor vehicle that's full principal and interest repayments from day one, and we change people's lives. And when I say we, it's the team. We've got a remarkable group of people in Townsville, Brisbane and Gold Coast now that understand our responsibility to all of you, but ourselves. So we are no different than most other companies. The only difference is the people that we have within our organisation that understand what we're trying to contribute and what we're trying to make is something special. And we keep each other truly accountable through all of that. I'm extremely proud of the team members that we have and extremely grateful for the support from all our investors. You've made the company what it is today. So thank you. Darren Cantor, he's my boss. He is our CEO. He's done a remarkable job. One of Darren's good traits is he can identify good talent, and we've transformed some of our team to add value in areas that we required. That does not discount our existing team members, though. We give every opportunity for somebody to pay us back. We give every opportunity for our existing team members to grow within the organisation. I have to evolve every year. I have to be a better version than I was last year to be able to continue the growth of this company. It's no different from my teammates. And they too are remarkable to come on this journey because they get energised by that. I'd like to welcome Darren to come up to the stage and give you an overview of how our business has performed over the last 12 months. Thank you, Darren.
Thank you. We just Good afternoon, all. It's good to see you all again. It's now 2 years into the role, so it's great to, I think this might be my fourth or fifth one of these sort of events we've done over the 6 monthly hurdle. So I think one thing that with Jamie, he says that I'm his boss. But I also think he also shares that story about him collecting money and scaling fences to remind me that he really is the boss. And if he needs to find me, he will. So it's like little subtle hints, I think that's what it is. So, but look, I'm pleased to give you an update on the business. It's been an amazing 12 months, or at least 6 months since we have seen you all. We have transformed the business in many ways, and I appreciate the comments of Darren in regards to identifying some of the work we have done on the business to ensure that we've stabilised the company and made sure we've traded our way through what was potentially some difficult economic times, and I'm really proud of the numbers that the team has produced over this period. A little bit of recap of the business. You can see there Townsville head office, and we've now got Brisbane and Gold Coast, and that's a growing team. We have over almost 200 staff across the group now servicing a national network. So you can see there we're still quite dominant in Queensland. So despite you losing the football this year, which was fantastic, you're still dominant in the lending that we do. But New South Wales is coming. So for those who don't, pick up on the subtleties there, I'm from New South Wales, and I'm going to gloat because it's been a long time since I've been able to do that. So, but one thing I look at that mix there, we have a national distribution. We have a number of BDMs across the country servicing our range of clients. So whilst we've had good growth, where we see great opportunities as well is in New South Wales and in Victoria. We've still got some good upside there. So we've got a very strong business in Queensland, but still some great opportunities ahead of us. A bit more of an overview snapshot there of where we're at. You can see the loan book there trending up to 530 odd million there. Processed 45,000 applications, improved 16,000 loans. So it's a big engine now. A big engine full of great people serving our clients. I can see Tanya there nodding away. She's sitting there. She's speaking to half those customers all the time to make sure they're paying. So there's a lot going on in the business. And 25,000 active customers now, and settling in excess of $270 million a year. It's a big number, and we've got lofty growth ambitions. And I'll explain a little bit more about where those ambitions and where those opportunities lie. Bit of an overview of the assets that we're financing. So whilst we're diversifying what we do, we're still predominantly lending money to cars. So circa 80% of what we do is still lending money to people to have an essential item, which is obviously often a car, which is to run their business, take their kids to school, or essential tool of trade for their life. And as Jamie alluded to before, they want to pay that back. They need that asset. This is a second chance for them, often mean their customers. So they are hell-bent on making sure they maintain that asset. You'll see there as well, we've branched out into unsecured cash flow. I want to call that out. That's an area of growth for our business, but an area of growth that we're treating cautiously. There's big opportunities in that space, but we are taking a conservative approach in that to make sure that we attract the right type of customer to the business. But overall there, what you can see is a good spread of assets, but still predominantly lending money for wheeled assets or cars. Probably one of our most important slides, and Darren touched on the fact that it's been some challenging economic periods, and we've obviously watched that very closely. But I'm so proud of the team for what we've been able to deliver to reduce the arrears. You can see the arrears have come down quite a bit, and especially in the last 6 to 12 months. And that's a real testament to a lot of the people inside our business to have that focus on lending money to the right customer. And we've had to make some tough decisions over the last 12 months. We have made a conscious effort to, for some of our more vulnerable customers, we've taken a more conservative stance to ensure that we're lending to the right customer to ensure that they actually can maintain that loan. And that's been some tough calls for us to make, and it's definitely impacted the amount of loans we have actually written, but we're so proud of the fact that we've actually written better quality loans. We've actually made changes on two fronts as well. So whilst we've also tightened up some of our more riskier customers, we've grown into other asset classes and other customer bases, and we're effectively moved up the credit curve. So we're lending money to better quality customers as well, which is a real feather in our cap because we've had to earn the right to do that over a decade. As Jamie said, he started the business many moons ago, lending money to those customers who typically fall outside of the traditional banks. We're not abandoning that, and we never will. But what we are doing, and through earning the right of building a good business with good brokers, we've actually got 4,000 accredited brokers that give us business on a daily or a monthly basis. So it's a big network of customers. But through our products, we can actually attract a different type of customer who is actually more creditworthy or more close to what the banks would traditionally lend to, which will continue to put downward pressure on that arrears. Jamie loves this slide. I was going to take this one out, but he's like, no, that's got to stay in there. He loves this one. So what it's just showing here is particular cohorts from the last sort of 4 years there. And what that's showing is their arrears position at 30 days for loans lent within that year. And what you can see there is 2024 and 2023 has performed much better than the prior years, where we did have some challenges with the loans that we had on the books. But you can see in 2024 there, it is looking extremely healthy. So again, further signs that what we are lending out there is actually strong customers, better credit quality, and more repayments coming through. If we take that out one step further, this is at the 90-day mark. So you can see the lines there, I can call that the orange line and the darker blue line down the bottom. There's 2023 and 2024. So you can also see that from when it comes to 90 days in arrears, we are performing extremely well for loans that we've put on the books in 2023 and 2024, well below our historical average. So why is that important? Well, that allows us to obviously reduce those arrears again, right? More money coming back in to protect the company, protect you as investors. But it also shows the great work that our team does. We understand that customers that we lend money to will go into arrears from time to time. That's the space we play in. But what this does demonstrate is we're willing to work with these customers. We're not here to then repossess their car the moment they're in trouble. We want to work with them, help them trade their way out of those particular issues, right? Because they will have issues. As Darren said, you pick up a paper, the cost of living is tough. We lend money to customers through bank statements. We look at their bank statements. And as Jamie has always said, we get to look inside their soul. So we get to look inside how they live their life. And we have seen it has been tough. It has been tough for customers. And we've seen that their balances are running lower progressively, which is why we've taken that conservative stance. But what that shows you as well is that whilst our customers might fall into arrears, if we work with them, right, we can get them back onto their feet. So we're really proud of those particular numbers. As Jamie mentioned before, we've invested in our talent. We've got tremendous talent. I'm so proud of the talent that we've been able to attract to this business. I'm so proud of the team that I inherited from Townsville effectively and to a lesser extent in Brisbane. But what we've been able to build in investing in the right talent, I was talking to Lachlan, our CFO, this morning, and we actually was just super proud of the depth of talent we've got across the entire business now. We are so well positioned for the next phase of growth. What I can say with confidence is that we've got a tremendous team, and you can see we're invested in that talent. But what it shows is when we invest in the right talent, it drives our profit as well. We're a people-based business. We're not selling anything that's not readily available with other providers. But our talent is what can differentiate us and can actually be the cornerstone of our next phase of growth. Some of our key objectives for the coming year. We want to grow our market even further. So as I mentioned before, we've traditionally played in the non-conforming space. We will stay in that space, but we want to grow into more what we call near prime. So again, better quality assets. And there's more opportunity available for us to take. We've only just really started to be in that space. We want to move into mortgages. We've been talking about that in our prior updates. We are getting quite close to being able to deliver a product to market, which is super exciting, because it opens up a whole range of different customers that we've not otherwise typically dealt with. So it's a huge opportunity for us. Our processes and people, we talked about that. So what we've done the last couple of years is invest heavily in really high quality people. The next phase of growth for us is investing in our technology to support those good people. Because there's no point having great people, which we do, and have them doing poor processes. So our next phase is to make them more efficient so that we can drive the engine even further. Credit management, as I mentioned, we maintain a huge discipline. And we can spruik that all we like, but the results don't lie. Our arrears is going down because of our credit management. and most importantly, protecting our investors. If we keep generating good returns, protecting the money by way of the losses are the only thing that can really bring us down, and as you can see, we're doing a great job of those. That in turn protects you as investors. Our collections business, we're really proud of this. I'm proud of the fact that we've taken our time with this. We have really stabilised our business and it's performing well. We've got some great opportunities there. So we've invested in buying debt. So just for those who are not familiar with our Gold Coast business, we acquired a company called Commercial Credit Control 4 or 5 years ago now, and it's a continuously based collector where we collect money on behalf of other companies, notably Optus and Vodafone. But we're now actually purchasing debt. So we're going out and buying bad debt and then collecting that is. And that's a growth opportunity for us there. And I'm so proud the team has been able to land some really strong contracts which we can build the business off. We moved into a new location down the Gold Coast. It's a fantastic office, super proud. I love going down there myself. For those who hadn't seen it before, I didn't go down there very often because I couldn't fit. There was actually nowhere to sit. We didn't have any opportunities. So we've actually got a really good space now. And I love walking in that office now, seeing the team just buzzing along. And we've got another opportunity to probably double the headcount in that office. And we'll double that through our collections business, and we'll also grow that through our Finance One business. We've done a really good job with our main customers of Optus and Vodafone to actually strengthen those partnerships. So we've had those partnerships for about a decade, and they have come to us and said they want to extend that and expand that remit. So that's the greatest testament we can have that we're doing a great job for them. So overall, we look at this last year for the collections business as more of a setting up the foundations, and we're really comfortable with the position that we're in. We've been very conservative to grow in this space because it's a new space for the company. So we haven't want to do anything too rash, but we've been sensibly investing in the right areas, and we're really geared up now, I think, for success. So with that in mind, I will pass back to Jamie. He'll give you a bit more of an update on our offer, and I'll come back a little bit later with Lachlan and we can answer any questions you may have. I thank you for your time.
Thanks, Darren. Really appreciate the update. At certain times, whilst we have ambitions to grow, it's not for growth's sake. We're not listed on the stock market. We're not beholden to a share price. We showed it during COVID where we completely stopped our lending and we regressed. So we will do that at any time to make sure that we meet our obligations to all of you. It is very, very important. And I've drilled that down into the executive team as well. Our financial highlights, Darren tapped on it, but $530 million for a current loan book, which is fantastic. That's up 21%. We've also had a profit of just under $19 million net profit before tax for the year, $270 million in settlements. And we've also got the securitisation funding there of $200 million to complement our investor funding of over $300 million. We've paid $27 million in interest to our investors for the last financial year also. Some of those highlights, $123 million worth of revenue, net profit before tax was $19 million or just under, and just over $13 million net profit after tax. But we've reinvested those majority of those profits back into the business, and we have over $55 million worth of equity back into the company. And we've also increased our provision for doubtful debts now. It's at $26 million. We've always taken a prudent and cautious view when it comes to our doubtful debts to make sure that we allocate appropriately for future bad debt expenses. Ladies and gentlemen, we offer you a fixed interest return. It's paid monthly. What we love about our company is we try to provide you a transparency. We want you to understand the business that you're investing in. You can start out small if you choose to, and you can grow that investment, where it should be only a small portion of somebody's balanced investment portfolio though. That transparency is key. Because you can come and understand the DNA of the business that you're investing in. The DNA is the people that are representing you, because they're the ones that will fight and do the right thing. I'm extremely proud that we offer a fixed term and a fixed interest. that provides you a certainty. You actually know, it's a known quantity of what you're going to get back as a return, and it's a known quantity of when you're going to be able to redeem that. It's just set. We've never missed an interest payment. We've never missed a maturity when it comes to redemptions. Right through COVID, we never missed a beat for the last 14 years. Extremely proud of our team. This is interesting. I like this slide. Thank you, Lachlan Brown, our CFO, for producing it. But it shows in the entirety our capital stack. So not only the money that we borrow from investors, but also the money that we've got borrowed, which sits outside the group, remember, from the larger financiers. Of interest, if you looked at the left-hand slide there, you can see our securitisation is at 200 million, but our redeemable preference shares is at 295. But we've actually got $313 million worth of preference shares. Of that, $18 million is team member money. Our team members, including myself, have put in $18 million through preference shares. Investors, you rank first in preference to be paid. Not only above myself as a shareholder with $55 million worth of equity, but our teammates rank second in preference to be paid behind you guys. So really backed ourselves for that business model. We've continued to raise funds on an ongoing basis from investors. Why we've had to go out there and expand and get a line of credit from a larger financier is because the business has just outgrown what we've been able to raise from investors. But we need your support. We want to continue to raise that. Our goal is to continue that and grow it by another further 10%. Referrals, they're an important part of our expansion. There's no way we would have been able to grow this business without your support, but also your support through referrals. Telling other people about our business model and the opportunity to invest with us. We offer a fixed interest return from $25,000 at just over 6% for a 3-month term, but flexible terms too. So we've changed some of those rates to make sure that we don't have too much money locked in for too longer periods of time. That's why you see that sweet spot at 36 months at 10.35 for $500,000. We are looking at changing our rates and refining our rates. It's important. Next year, they're talking about an interest rate cycle that's going to be coming down, and we wanted to be transparent with that to be able to show you our proposed rates that are going to come in December. Only some small tweaks, but it's really important that we remain competitive in the market space for a capital cost. So what are our costs of capital? So these will be the new rates that will come out in December, so some small tweaks. That does not affect your existing investment. All right, so your existing investment comes full term. When we first started, we were paying up to 18%, and some of our investors locked that in for a longer period of time of 5 years. We continued to pay that. Even in an interest rate environment where it was going up, we even allowed investors to top up their investment and reset for a larger term, for a larger interest rate. So we've prided ourselves on the support that we have, and your relationship as an investor is paramount to what we do. So thank you. That wraps up our presentation for today. We are happy to answer any questions that you might have, and I'll introduce Lachlan. If Lachlan can come up and Darren can come up. And so Lachlan Brown has joined our organisation just recently, the last few months. I'm really pleased that both Lachlan and Darren are both investors too. They've fronted up their own capital. Darren's parents are investors too with the company, so they believe in what we're doing, and they've ranked their capital behind everybody else as well.
So the first question is, you mentioned growing addressable market. Can you please expand on some of these opportunities? Darren?
Thank you, Lachlan. Addressable market. As I mentioned before, what we want to do is move outside of this. We've almost saturated to a point the non-conforming space. So our growth opportunities in that space are somewhat limited. So we don't want to stand still, so we want to move up. So we want to look at a couple of things. We want to grow our cash flow lending sensibly. We also want to grow bigger ticket items, so an area to actually expand some of our lending into some bigger asset classes, even up to $250,000 on an individual transaction. So that opens us up to different asset classes that we traditionally have not lent to. And I mentioned before mortgages as well. Mortgages is a huge venture for us as a business, but it opens up a lot of opportunities for us. I mentioned before we've got 4,000 brokers. Well, there's 18,000 mortgage brokers in the country. We don't really deal with any of them in any great scale at the moment. So that's a huge opportunity for us to tap into that market. And whilst we tap into a new broker market of 18,000 mortgage brokers, they also write asset finance. So it's another way for us to grow our core business off the back of leveraging those.
Beautiful. So on the commercial unsecured cash flow products that we have, it sounds risky, and an investor has questioned that. Can you explain maybe to the group and the investors, what are we putting in place to make sure that we recover the principal on what we're letting out?
We take out a director's guarantee over that loan as well, but we also get 6 months worth of bank statements, making sure that what are they borrowing that cash for is principal to their business needs. And what we've found, is we piloted this for a little while, is they come back. It's so tough for businesses to find working capital to their businesses, and they appreciate it. We work with them over a period of time, and it's worked very, very well. So we're able to have with margin with that product. So there's a good margin there for us to be able to make sure that we can cover any of those losses. And it was bullets before cannonballs. So we made sure that we took the same cohort that we looked for a profiling of that customer in regards to the individual that's running that business. We've got 14 years of lending experience, understanding that cohort and understanding the profile. So whilst it is technically unsecured, we take out a director's guarantee for that as well.
Perfect. We had a question around our people, and there's a lot of our employees around the room now on various tables, and we talked about our growing presence in terms of offices, a large new footprint down the Gold Coast. We have a large footprint up here. There's a lot of companies going through the cycle at the moment trying to encourage employees back into the office. So are we experiencing this, and what are we doing to entice people back into the office?
Never let them go. That was the thing. We actually didn't let them stay home, to be honest, for the most part. So as a lot of finance companies did have their staff working from home. I'm really grateful when I first started that we, from a Townsville perspective, we had people coming into the office, and that then flowed through to Brisbane. So what it means is that we're trying to grow our company, we're trying to invest in our people, and we want to keep growing the culture. I challenge any company to say, how can you grow culture if half your staff are working from home every day? So we're really proud of the fact that we want our people in the business. When they're in the business, in the office, you're collaborating, you're sharing ideas, you're sharing pain, you're sharing pressure, you're sharing all those types of things. It's hard to do when everyone's at home. So I've been really proud of the fact that we've held firm. And it's been challenging at times. I've had many staff going, competitor A is offering this, and competitor... And we've held firm and said, we respect that. But where we want to grow, we want our people invested and understanding. And I have a very simple view on that, is that if someone's working from home, the job is very commoditised to them. If they get offered any given amount more, they might just go, well, if I'm still able to work from home, there's no attachment to the brand, there's no attachment to the people. You can't get that attachment, in my opinion, if you're working from your living room. So we've been firm on that, and we'll probably remain firm on that. That's not to say we won't have flexibility, of course. There has to be a hybrid situation, but we make no apologies for wanting our people to come in and work with us every day.
My wife and family have been investors. I'm not ashamed to say that now we're very healthy, wealthy investors. But there's two questions. What's the biggest challenge that lies ahead for Investor Central? And Darren just mentioned the bigger ticketed items. What are you looking at? Real estate, housing, or what do you mean by bigger ticketed items?
The biggest challenge for Investor Central as it moves forward is not picking up too many sticks and dropping the lot. Success breeds failure. So creating the DNA within our company, and making sure that we don't lose sight of who we are and what we do. We don't need to be the biggest in town. We don't want to be the biggest in town. We just want to serve people well and serve each other. That's the biggest thing. So making sure there's There's a book, it's my favourite book of all time. It's called How the Mighty Falls, and it tracks 10x companies and what they did wrong. And the biggest thing is arrogance. Arrogance will bring you undone. The next one is a denial of the empirical data. So not seeing things that I'm determined that won't happen to us. When it comes to the $250,000, there's assets there that we're unable to finance at the moment that are critical to some businesses. So let's just say you're a homeowner, you're a fairly sophisticated business, but you need a $250,000 vehicle or asset that's going to improve that business. We will consider that. But you have to be a homeowner too. So again, there's a director's guarantee there as well. So we're taking security not only of the vehicle, but we're looking for an additional security for that.
Okay, the next one was around previous luncheon. So in the previous luncheon, I think both of you talked about a weakening economy and a worsening economy. So twofold, have we seen it and what have we done about it?
Have we seen it? In short, yes, we have, because we lend on bank statements, but it hasn't been as bad as we probably first thought, which has been really pleasing. Customers have shown a real willingness to continue to pay. But as we mentioned before, when we lend on bank statements, we can see what's really happening, right? So we have been more prudent in regards to some buffers. So when it comes to lending money, it's not just making sure that what they pay now, we make sure there's a buffer, like a rainy day buffer, if you like. And we've increased that, right, to be prepared for the fact that some customers may be facing some challenges. But what we've been so proud of is that despite there being some challenges, we've been very disciplined to say no to the right deal. A little bit like what Jamie said before about what could bring us undone and what's our biggest challenge is. The biggest challenge is probably what we don't do, right? There's plenty of opportunities out there for us to do. It's what we say no to is what we've got to remain focused on. And what we've been good at is saying no to certain parts of our products that we typically would have said yes to. We've been proud to say, no, that's not for us right now. And we've held firm on that. And that's challenging. I'm proud of the team because often there's pressure to go, well, you used to do that. Why don't you do that now? And we've been conscious of that. So yes, it's been tougher, but the decisions we've made have proven that's held us in really good stead.
The focus and discipline resulted in us making two changes. One was at the end of the financial year last year, and also at Christmas time. And you can see the benefits of that. So we were really prudent when it comes to that.
There's a lot of discussion regarding interest rates lately in the media, and we touched on it just before, and that there's a sentiment that those rates are going to be going down next year. Do we have a view, and what impact will that have on IC rates?
We have to remain competitive in our industry sector. We've got rates from 12.45 that we're able to offer to our consumers now. We're really proud of that. We're able to help a broader range of customers that we've ever been able to help before, but we've got to make sure that our cost of capital stays in line. So that's why we're constantly refining that to make sure that we provide you, the investor, the best possible return. We want you to stay with our company for the next 14 years. So that's our ambition. So we will have attractive rates out there, and the moment that we don't, you will start to leave, and we've made a mistake.
I think we've also got the sophistication in the business as well, looking at the market rates, what's coming out, and making sure that, as Jamie says, we keep these rates attractable, but we also are very conscious of the cost of capital to the business.
Why is favouring 3 years instead of 5 years for your higher interest?
Would you like to answer that, or would you like me to?
No, I can go, and then you
thank you.
can correct me. So the reason why we're favouring the 3-year loan is because we just talked about the interest rate volatility in the market as well. And what we like to do here is we like to fund our program at 36 months, which is a bit shorter, and we like to lend at the 5 years as well. So that way we can keep nimble in our interest rates and keep our rates attractive as well. So if we lock in a 5-year rate that's too high, that limits our ability to then make these rates as attractive as they are going forward over the next 3 years, where it is a downward trend in the interest rate cycle.
We had we used to have a 5-year term. We were in 18%. There was a 16% club, an 18% club, and we locked ourselves into very high yield returns to our investors, but we paid them. but there was a cost to that. So we're just trying to have that flexibility to make sure that that doesn't happen again. I am grateful for your ongoing support, and I will not let you down. Thank you, everybody.